Welcome to Trading Nation. I'm Mike Santoli. The Federal Reserve hiking interest rates by 0.25%, sending stocks off their highs from the session. Craig Johnson of Piper Jaffray, Mark Tepper of Strategic Wealth Partners join me now for instant reaction. So, Craig, I guess the first thing to say is this market coming into the Fed decision was very much oversold and primed for some kind of a bounce. Where do you think this all leaves us with the market?
You know, Mike, I look at where we're at with the market right now, and you're right. We were very oversold coming into this. In fact, this morning we actually raised our recommended equity to recommendation at 90% from 85%, as we continue to think that the market is very oversold on our work. We've also corrected right back. When you look at a long-term chart of the S&P 500, we've corrected right back to the long-term uptrend support line, and I think that's a level that's going to hold. I think the initial reaction here with the Fed raising rate 25 basis points and continuing to leave several more increases on the table, I think is probably the right decision on their part. And I do think there's a lot of underlying support under this tape from a technical perspective. And I think it's so oversold that this is a spot where we want to be buying equities on this dip, not selling equities at this point in time.
Mark, there were a lot of expectations getting built up that there would be a much more pronounced dovish move by the Fed. Of course, a lot of folks even saying maybe there shouldn't have been a hike at all. Does the substance of the statement change your broader outlook for what markets can do here?
The main thing I'm focused on is really the fact that they reduced their forecast for hikes in 2019 from 3 to 2, which leads me to believe that it's much more likely that they could and should potentially pause, which would be bullish for stocks. So, I mean, already with them unwinding the balance sheet, that's the equivalent of 3 rate hikes in 2019. So, you know, the real question right now is how should investors be positioned, especially given the fact that we're late cycle. And I actually see an opportunity in some of the most beaten up stocks out there. You know, we've seen such a sharp correction in technology stocks, and sentiment has become so negative. But I actually believe that the tech mania bull market is still intact. So the question is, what's going to be that catalyst to get these stocks back on track? And I think it's much more likely to be that friendly monetary environment than technology-specific developments. And that's what we will hopefully see with the Fed in 2019. So growth sectors like tech tend to outperform value sectors when the economic backdrop is boring, which means low inflation, no recession. In that environment, stocks with growth potential that aren't cyclical or defensive tend to overshoot. And it's also important to realize that the tech mega cap leaders of this bull market have pulled back so much, but their earnings and revenues are still expanding. So, you know, I think there's great opportunity in a lot of those beaten up names.
Yeah, low rates and relatively slow growth have often been good for growth stocks. We'll see if that develops from here. Mark and Craig, thanks a lot for joining us today. Thank you for watching Trading Nation. I'm Mike Santoli. We'll see you next time.